Hi, everyone. Welcome to the Business in Calgary podcast, powered by Sonic Coaching. I'm your host, Oliver Basner. I'm pleased to be sitting here with John Jeffrey today. He's the president, CEO of Saturn Oil and Gas here in Calgary. Also was on the cover of October's Business of Energy magazine. Few awards I want to talk about as well here. So Saturn was the 2025 recipient of the Business Report on Business, Canada's top growing companies, and the number one company in energy and utilities for the Financial Times, the America's fastest growing companies for 2025. And John, I know you were recently recognized as an exceptional business leader by Business in Calgary magazine. So first of all, congratulations and welcome.
Thank you very much. Thanks for having me. It's a pleasure to be here.
Lots of awards there, so obviously some things are going well.
Yeah, growing is easy if you can get the right people and the right things around you. But it's been a whirlwind of the last 7 years for sure.
Awesome. Well, let's go before then even a little bit, if that's okay with you. So originally you weren't even an oil and gas company, you were a mining company. So tell us about sort of what caused the company to pivot and how did that transpire?
Yeah, so my partner and I, Justin Kaufman, we got involved in 2016, 2017. So at the time the company was Saturn Minerals.
Yes.
I believe it was incorporated 01 and public in 03 or 04. And they were just a junior Vancouver-based mining company. So I think they had some gold properties at really early on the beginning where they moved to Saskatchewan, and they had actually found at one point a 38 meter thick, a really large coal seam in northern Saskatchewan in and around Hudson's Bay. And while they were drilling for that, they thought they had come across some oil. So where Justin and I came into the picture was they reached out to a company, a consulting company that him and I had.
Right.
And what we did is we were sitting wells for people. My background's finance, his is geology, so we had a number of geologists that worked there. So being we had drilled over 1,300 wells in the province of Saskatchewan, 4 different companies. So we had built up, a pretty solid reputation. So when they thought they had discovered oil, they had reached out to us, given our background and expertise, and they said, "Listen, we thought we had oil. Could we've raised some money. We want to drill some oil wells. Can you guys help us out?" So that came about in about 2016, and that's where Justin and I came in. Now, unfortunately, those wells, we were just paid to kind of sit the wells,
right,
not explore for them. Those wells didn't turn out for the company, and in short conversation with some of the shareholders behind Saturn Minerals at the time, who were actually largely German-based, they had said, "Listen, coal at that point, the pricing of coal had really collapsed. We would really like to become an oil and gas company. Can you guys help us?" So, short conversation there. Justin and I in 2017 said, "Sure, we'll come over. We'll take over as management. If you guys kick in some cash," because it was an existing company.
Yeah.
It didn't have any cash flow. It was just an exploration company. So we were able to raise a few $1 million, and with that we set out and drilled our first few wells in the Viking. And what was really exciting there is given our background as consultants, we had done a lot of work. We had done a lot of mapping for other companies.
Right.
So even though we had a very limited budget, and oil prices at the time were kind of mid-60s, we were able to completely develop a company on nothing but greenfield sites. So for the first few years of the company, we had never bought land with reserves or with production. It was all just greenfield. And that was thanks to Justin and his team and what we were able to build there. So that's how Justin and I got introduced into the story and how it kind of morphed from what it was to what it is today as an oil-focused company.
Great story, fascinating,
Yeah.
right? And probably some risks and some bumps along the way, which I'm sure we'll talk about here. So now what makes Saturn different versus your competitors? I mean, you've got a lot of competition out there.
Well, again, when we got started, we had no money, right?
Yeah.
And so on the weekends, we would go into the field and we would take sites apart. We do whatever we could to save money. And so our focus has always been geology first and maintaining our operating costs. Those have always been our priorities. I think a number of companies out there, especially ones that are around for the 2012s and 13s, when you get $100, $120 oil, your focus is growth at all costs.
Right.
That's all that matters to you. You don't care about who cares about cost when all you have to do is get another barrel on because you make so much margin on it. To change that mindset and to shrink, when you're growing it's easy to ask everyone to do 120%.
Yeah.
When you're stagnant or shrinking and you have a bunch of people working at 80%, it's incredibly hard to shrink that workforce down and to all of a sudden get them to care about the small costs and get them to look at all the little operating details that allow you to operate as efficiently as possible. So that's always been our focus, and that's, if you will, a luxury of having, started in $60-65 oil. So that's one thing that has always set us apart, that, to us, the scarcity is the oil in the ground, which is to say, when we drill a well, a lot of companies will say, we're going to drill it as fast as possible, as cheap as possible. And those are priorities, but the number one priorities is how much oil can we pull out of the ground?
Yeah,
the scarce resource here is the oil. Let's get every barrel out of the ground so we can maximize the cash flow off these wells, especially at the beginning when you're drilling 1-2 wells here and there, and you needed every barrel, and every barrel that came out we needed to maximize the profit on every one we could sell. So that has always kind of been our focus. I understand some other companies, it might be growth, it might be whatever it is, but for us, it's keeping our costs down and getting every barrel of that resource we can out of the ground.
It's interesting, because as I hear you talk, as a young leader years ago, I remember it was a senior manager who, I remember when he said to us as a team, he said, take care of the pennies and the dollars will take care of themselves. And it sounds like you learned that right from day one, and you're still doing it.
Absolutely. I mean, but but not only do you have to have that, your team has to have that. It's all the way down the organization. I was laughing the other day. I was listening to one of our VP of Ops. He was lecturing a foreman. He said, I was at one of your dog houses the other day, and he said, I went in there, and on the table you have new hammers and new wrenches with price tags on it. And he's yelling at this guy, and he says, how many hammers do we have in every one of our trucks and dog houses? And there must be hammers everywhere. Yeah, what the heck are you doing going out and buying new, so just that mentality of, it's a double-edged sword, because, VP of Ops, I don't want him worried about a hammer, but at the same time, the culture of this, we're not here to waste money, even if it is a hammer. What can we reuse? What can we recycle? Where can we shave costs? Through everything. And so it's those little things that, especially when you get bigger, it's different. It's more difficult to get that message and culture down to the bottom. But I think what we've gotten really lucky with is we have some really, really good, senior management in the company that has taken the culture that we were able to build at the beginning and really push that down. So even today, we're able to continuously cut costs, and we're seeing those margins per barrel continue to rise year over year.
That's fantastic. You know what, I wanted to dive in a little bit about culture, since you brought it up, which is, you've gone from, originally it was 5 employees, right? You're over 400 employees now. You've got 3 offices. How do you keep that culture alive? How do you keep that original culture going? Because that's so hard when you get into you can't touch everybody every day. Your VP can't touch everybody every day. They're out in the field. They're everywhere. How do you?
It is tough, because at the beginning, you had some guys, well, I'll take a chance on you, but you're trying to attract talent from Cenovus or CNRL or. There's some big stable companies out there, and why would their top guys risk coming over for you, right? So you have to offer them something a little different. So it sounds a little corny, but tech startups attract talent because they have a good culture. So what we've always been is a bit of a younger, hungrier management team. Before we ended up buying Ridgeback, the average age of our company was 34 years old, and what our culture always was, we'd work long days, but then when we had the opportunity, we'd go and work hard, play hard type thing. And so those are always things, and we try and uphold that. So at least once a quarter, we'll do a company event. Whether it's something, if we do a town hall, then maybe we'll go bowling afterwards. Or we have a golf tournament, and the field offices are the same. And even our Christmas parties, we try and get executives out at every one of our Christmas parties, even if they're in the field, wherever they are. We try and attend those, or golf tournaments, or whatever it is. You have those town halls, you have them on Teams so you can see everyone. We do them from the field. We get different groups invited. We try and blend as many people together as we can. We'll take accountants and say, okay, get to the field and to spend some time with some operators. Understand what their day looks like. Understand the hardships that they have.
Right.
So that when we're looking at numbers, you're not saying, hey, what the heck's this guy doing? He's late or whatever it is, and you can understand, oh wait, he's not operating in a Walmart parking lot.
Mm-hmm.
They're in the field, they're in the snow, they have these elements, they have these challenges, and if you can get a general appreciation for what everyone else in the company is facing, the problem is if everyone's siloed, it's easy to think, well, I'm working hard, but that guy's not, nuts to him, he's not doing as much work as I am, or my job's harder, whatever it is. If you can get exposure and you can get everyone to really pull in the same way, so it's not my team versus your team, it's one team, it's a Saturn team.
Right.
And if everyone can see the hardships and challenges that other people are facing, not only can you get some more ideas, but you just get more teamwork and collaboration. At least that's what we found.
Love that, actually, and I don't hear that very often where you've got even the finance people out in the field kind of understanding what's going on. So there's a real cross-pollination that happens, and they start to understand each other's roles, right?
I forget where this came from, but one of the keys to investing in a company, I've always heard was like, sure, the CEO, this is old, the CEO can walk you around the factory floor and tell you what's going on, that's fine.
Mm-hmm.
But if the CFO can walk you around the factory floor and explain to you what's going on, you've got a real business you can invest in. In other words, can you bridge those two? Can finance actually get in on the business? Because if they can do that, there's a lot more value they can add, and you have a much stronger business. So it's the same thing with
Right.
us. Is we want everyone to understand what everyone else's role is.
Yeah.
If you're an operator in the field driving around in -40, you could be thinking, oh, what the heck are these production accountants doing, or these IR people? Well, what are they? I'm out here making all the money, doing the hard work, and they're sitting in a cozy office. But to actually get that appreciation for one another's job, I think that's one of the keys to hopefully what we believe to be a good work.
And I don't know if your CFO's listening, but hopefully he knows he's got to know what's going on the floor, right? Or in the field anyway, in your case, so
this is not news to him, I promise you. So when he does listen to this,
he's
he'll
gonna
know
laugh.
exactly what I'm talking about.
That's great. Now, when you hire, do you hire considering cultural fit as well? Is that part of the culture that, do you hire for that fit?
100%. So, we have thresholds, so you have to be experienced enough.
Yeah.
Past that, it's all fit. And that's how we've always looked at it. Obviously, we can't hire nobodies to be CFOs, things like that. So you look for candidates that are qualified,
Mm-hmm.
but then you go with fit. That's how I've always done it. Just because you have a PhD or whatever it is, that's fine and great. But if we're going to work 14 hours beside each other, and we're going to be in stressful situations, and you're working on a deal and everything's going wrong and everything's falling apart, it's the fit. That's what carries you that extra mile.
Right.
And that's one thing we've always looked for is, there has to be a cultural fit there. You have to be able to go to bat for that guy and vice versa, or that guy and grow. So there has to be a fit. So, for us, like I always tell, especially our younger managers, that instinctively want to say, well, I'm leaning towards this other candidate for the role because they have 20 years experience and this guy's only got 16. And you say, okay, but for the job we're looking for, if they're both qualified enough, who's a better fit? Who do you think, who do you want to have a beer with? And who can you get along with over the long term? Because if it's a guy with a little less experience, but he's a better fit, maybe we should look at that.
Right.
And that's one thing that, we've always kind of leaned towards, is really go with fit, because we are instilling a certain culture, and we want people that really appreciate and lean into it.
No, it's great. Thank you. Now, you've had tremendous growth over the years, and a lot of it, significant amount of it through acquisition. And I'm, did some research. You've looked at over 120 prospective acquisitions, turned down most of them, right? How do you decide? What are the things that you're looking out for in an acquisition? What are some of those learnings for those people that are listening and they're going, well, you know what, I'd like to do an acquisition. So what are you looking for?
Yeah, it's 4 or 5 years ago, going into I think June 1 of 21, I think we were 300 barrels a day, and today we're 44,000. So it's been a fast growth, and over that period we've developed what we call the Saturn blueprint, right?
Right.
So we know what we want and we know what we don't want. For example, what we're looking for is, if we can't add value to an asset, I don't want it. So if it's like a non-op partnership or something, I have no interest.
Right.
We know our weaknesses. We're not heavy oil guys, and we're not gas guys.
Right.
Okay, well, that eliminates a lot, right?
Yep.
So we are relatively shallow, light oil. That's our focus. So, you look at the Montney or something. So, you start looking at $15 million wells, and all of a sudden you want to drill a big pad, and it's a $100 million pad, something like that. That's not what we're set up for. That's not our bread and butter, so we avoid those plays. Now, what you do start to look at, okay, relatively shallow light oil. And what we've seen is if we can build contiguous blocks of land, if it's southeast Saskatchewan, southwest, in the Cardium, we could really leverage the strengths that we have in these areas. So, for example, Saskatchewan, we're one of the biggest infrastructure holders. 6,000 kilometers of pipeline, 200 facilities, one of the only producer-owned gas plants. Those are advantages to us. So we can add on blocks of land where we can take advantage of those operations, and we can extract those synergies and reduce those costs. Now those are assets we want to go after. So, and that's how we kind of view everything, is how can we add incremental value? Because, listen, a well is a well. You take one well, it's going to decline at whatever rate it declines at.
Yeah.
If you own it, it's the same decline if I own it. On the margin, maybe you can shave 5 or 10% costs off it. For the most part, it is what it is. So whoever owns it, it's the same thing. So how do you add value? Well, now if all of a sudden I can take that well and put it into my infrastructure system, reduce my processing costs. All right, now that's material. If I can gather and process the gas myself, okay, that's even better. If I already have operators in that area and I have a hierarchy structure with safety and superintendents and foremen already built out, and there's not a lot of incremental costs, now all of a sudden it does favor me to own that over the next year. So those are the things we really look for. Now, the problem is, in oil and gas, I'm going to oversimplify, it's relatively easy if you had unlimited money, right? Like you said, our growth is through acquisitions.
Yeah.
So, and I think the advantage that we've had is where we got started there in doing acquisitions in 21. A lot of the banks had kind of pulled out. They weren't funding startups. The private equity wasn't there. The public equity wasn't there, and so lots of companies were selling assets due to the lower oil price. And normally what you'd see is 10, 15 startups that looked a lot like Saturn all vying for these assets. But you weren't seeing any of that because they didn't have the debt support and they didn't have the equity support. So you had assets for sale and you had no demand, and price goes down. So what we did at the beginning is we got good at, I think, what's been coined as shadow banking, right? So non-traditional sources of capital. We went through a few of these. Now, the trade-off is it's a higher interest rate.
Of course it is.
We were paying 12 to 16% interest. With the understanding was, well, and people would kind of criticize, oh, that's way too high of interest. And you're saying, it is, but I'm paying 1.5 times cash flow for assets. That's the trade-off. If everyone had 5% debt, these assets would be 3 to 5 times, but they're not. So if you have capital nobody else does, once you get to a size and scale, you can get capital. You can get competitive capital. So our plan was, listen, let's lean into this, gobble up what we can, and we'll pay what we have to. But most of our assets we bought at less than 2 times cash flow, less than PDP, which meant if you took any of our deals and you hedged out the next 2 to 3 years of cash flow, 100% hedged, you would pay off all the asset and still own the asset, still have cash flow for years to come.
Right.
So there's really no risk there.
Yeah.
And we understood that was our strategy, and we understood that once we got to size and scale and we took that back to the market, that we could refinance, which is exactly what we did in 24. We were able to refinance it all down to 9.5% interest rate, which is great. So we were able to use all those stepping stones, take advantage of that shadow banking world in order to get to a position where now we can be competitive on the interest rate size, and we've already got those assets in the bag. So that was our kind of approach to it, and so far it's working pretty good.
Good. Yeah, it's puts into perspective, that a 5% mortgage on your home, probably not so bad.
Not so bad, right?
And I remember, Dad. I've got some years on you, and I remember, when Dad was talking about those 18 and 20% interest rates, right, back in the day on mortgages. So when I hear 5, I go, yeah, It's not as good as 3, but it's 5. It's really not much,
But,
right?
but here's the exact same thing is, and I've pushed back on my own father for this. Oh, back in the day, you had an 18% mortgage, right?
Yeah,
I said, sure, what'd your house cost?
exactly.
It was 75 grand or whatever it was, right? 60 grand.
It wasn't $1 million
Yeah.
or more, right?
But that's the point is, so if you thought, listen, if I buy 2 or 3 of these at 18%, then I can refinance it all at 5%.
Yep.
Of course you would.
Of course
Right?
you would.
That's the whole game, and that's exactly what we've done here.
Yep.
Is because it's 18%, because there was a lack of capital in the space.
Mm-hmm.
We knew prices were coming down. We were going to pay more up front, knowing we could refinance at a lower level
Totally.
later. So luckily that came together for us, but now it seems like I think capital's flowing back to the space. We're seeing prices move up, seeing a couple more startups, some more private equity, a little more public equity interest, and the Canadian banks seem to be turning the corner on that, which is a good thing for the industry.
Now, are you encouraged by what you're hearing over the last year out of Ottawa? I mean, there's more talk about the industry and, creating, moving the oil and pipelines. Is that encouraging to you? I mean, are you an optimist or are you cautious about that whole conversation?
It's always painful to think like, oh wow, there's some level of common sense that's coming back. Like,
To government.
one of the biggest exporting industries we have. That's good for the country.
Yeah.
That's neat, great. Finally, they've recognized
It pays a lot of bills.
what is
right?
clearly in front of their, so that's a good thing that
Yeah.
they can see the obvious part. Cautiously optimistic. I mean, talk is cheap. Is this?
Mm-hmm.
If you've read his books, he is in favor of carbon tax. He's generally anti-oil.
Yeah.
So is this a response to Alberta threatening to separate, or is this a response to now he's in power, he can see the numbers, he can see the books, and you understand this is truly the right path
Right.
for Canadian success? I don't know.
I guess the next few years will tell us.
It will. So, if Alberta separatism disappeared tomorrow and all of that goes away, is there still that urgent need from Ottawa to get more egress for our oil? And you hope it is, because in our opinion it makes economic sense. So we'll see.
Yeah. Just thought I'd throw that out there since
Yeah.
we were talking about.
I think it's better than it was.
Yes.
It's not great yet.
No, exactly.
But
And
yeah.
and as you say, talk is cheap, right? Let's see what happens.
That's right, yeah.
So, tell us about the spirit of giving back at the company and being part of the community. Like I know that's a big part of the organization. So talk a little bit about that.
Yeah,
Why is it important?
Well, especially in some of these smaller towns, when you get into Saskatchewan, Northern Alberta, and you get into some of these smaller towns where, such a big, percentage of the population works for you, or, when you look at Saskatchewan, specifically southern Saskatchewan, oil production used to be 40% higher than it is now. And there's a lot of money, a lot of jobs that aren't flowing into these areas.
Right.
And so now when you look at, whether teams or charities, whatever it is, it has created hardships, because if there are some micro recessions going on in some of these smaller towns, so be able to kind of step in and fill these voids, because it's farming and it's oil. That's what a lot of these communities have. Now farming hasn't changed much. Most people can't afford to get into it, and without oil kind of being there, we just like to support those areas that support us. And so we always have a few flagship projects that we try and support. Ronald McDonald House being one of them, Cancer Society being kind of at the corporate level, and then we try and push as much down into the fields as possible. I had a funny one. We in Carlisle, the curling rink came to us and said, hey, it'd be great, we'd really love a donation, we can get your name in the ice and everything. We're just a little short on funds. And we said, sure, how much are you looking for? He said, yeah, $500. We're like, okay, 500, is that what $1,000?
That's a rounding error in your company,
$500. Right? Like, then you just even food banks. You go to food banks and stuff. At Christmas time, we try and support those.
Yeah.
And what they're asking for is, gee, if you can spare $1,200, that would
help them.
That would help out so much.
Yeah.
Can you use $2,500? And like, no, like $1,200. So you realize that what is a rounding error to us makes a lot of difference for a lot of these areas. So that's what we try and do. We try and help out as many of these places as we can. There was what was it, in southeast Saskatchewan, in Estevan, they put in a new piece of imaging for healthcare. I think it was a CT scan, but again, the fact that they had to drive 4 hours away to bring that and to help support these things. These are all projects we love to do. Again, everything we do is only possible because of the people that live there and work there. So in order to give back and make their life a little easier, that's just for us.
Just makes sense. Yeah.
And it's our workers, it's their lives, it's their communities that are improved by that. So hopefully they're a little happier. And I think there is a sense of pride when you go to the ice rink or you can see the Saturn logo and they play, that's our company. Like, I've been to a lot of these small towns and we'll have some of the operators or some of the crew there. Oh, come look at this, and that's our junior A team and there's our name on the boards, or thanks to this, our name is here and we've supported these things. And they take a pride in that. I like that.
Well, they're proud to be part of the company and proud that the company's giving back to their community, right? So that's great. We're getting close on time, but I have kind of a couple of questions I like to ask all my guests. And so I want to start with the first one, which is always the looking back question. So, what do you wish somebody would have told you at the start of your journey? That person that's listening right now, that's maybe at the beginning of their journey. What's that nugget or that piece of wisdom you could share to save them some pain?
It depends what they're trying to do. So oil and gas is different because it's so capital intensive. I've had lots of friends come to me and they said, listen, I want to start a business, right? I need $1.5 million, or I need $2 million. I'm honest with them, I can't help you. Now, if you want to buy a restaurant or something, I can't help you. Now, if you want to buy a national chain of restaurants and you need $50 million, I can help you. If you need $100 million, that's even easier yet. And once you start to realize, and it depends on the industry, but once you realize how money managers and fund portfolio managers and everything operate, so for example, let's say you manage a portfolio of $1 billion.
Right.
You got a couple guys that work on your staff, that's great. Okay, so you have a stack of cash here. How many people would you need to deal with if you handed out $1 million at a time? Now, keep in mind, you've got to keep up to date on their business, you've got to check their financials, you've got to keep up to date with them. You have all this due diligence to do. Now, what if it's 50 million?
That's 1,000 people, right?
1,000 people.
Yeah.
Now, what if it's 50 million or 100 million? Now, all of a sudden, I only need to keep track of 100 people or 200 people. Now this becomes a little more manageable. So, and yet at the same time, okay, I've got $1 billion in this make-believe portfolio. I don't want to own more than 10% of your company because I want to be able to get it out. Okay, well, now we've kind of narrowed it down. Now all of a sudden your market cap has to be a certain size. But what you learn is you can put yourself into their shoes. Because keep in mind, I think a lot of people get hung up when they go into these meetings and they're meeting these portfolio managers. They think, oh man, I hope the other guy on the other side of the table doesn't know more about my product than they do. and they don't. They're money men.
Of course.
How can I make my return? What risk do I face?
Yeah.
So if they're world's finance and they're speaking finance, you've got to engage them on their level. That's the advantage we had. Is my background's finance. I could speak it. I could understand it. It's not that you're trying to explain to them how you've designed a better mousetrap. Is you've designed how, you've explained how you've taken the risk out of mousetrap selling and how do they get their money back and where their return is, and you've brought them, I need 250,000, okay, get out. No, I'm taking this nationwide and I need 25 million. Okay, now you've piqued their interest and you've presented it in such a way that they could understand the risks and everything. So if you can do it in that way, so put yourself in the shoes of the other person.
Know your audience.
Yeah, it's exactly right. What are their priorities? It's going to be risk, it's going to be return, it's going to be portfolio management on the backside. So how can you really engage with that person? That I think too many people these days get caught up with trying to explain the fact that, but look, we've taken the spring out here and I've just designed a better mousetrap, and they're like, I don't care, how do I make money on this?
Yep.
And how do they view the problem? So looking at it through the lens of your audience, that I think will overcome and get a lot more people on board instead of just trying to sell the product, is understanding who your audience really is there.
That's great advice. I mean, probably your younger self would have benefited from that advice. At some point you would have saved some schools of hard knocks, right?
So when you're dealing with generalist investors and you're going on about reserves and PDP and decline, and you realize, like, this guy doesn't know what the hell I'm saying. Doesn't
even know the acronyms.
No,
right?
he doesn't. And then you're like, oh yeah, well, you're a generalist, you deal with next in your office is going to be a tech guy, and then a grain farmer, and who knows everything that he sees in it. He can't be an expert on everything. He's an expert on finance.
And he wants to make money.
Yeah, and he wants to make money. So how do you relate it back to a guy that's all they do all day long is see pitches from every different industry and every different thing? So, and that's where I think a lot of investors and a lot of startups can really benefit from just narrowing that message down so that the audience has a couple key takeaways and it's clear on the things that they're prioritizing.
That's fantastic. Might have helped a couple of listeners here right now. So, being in the business that I'm in, which is coaching, leadership training, and running peer groups, one of my philosophies is that personal development and professional development are really one and the same. You've got to grow yourself as a human to grow, your leadership and everything else that goes with that. What's been one of your favorite self-development books or tools that you can recommend?
Oh, well, that's actually a great question. For us, it's really understanding, I would say, time management and just being honest with yourself on what are your shortcomings. So, for example, I had the problem, which I think the next generations after us is going to be worse and worse, with attention. It's jumping around from task to task, and all of a sudden you get an email come in, and you jump into that, and you drop what you're doing here. But once you kind of realize your shortcomings, and I understood that, paying attention to one thing and setting yourself. For me, setting tasks and blocking your calendar and prioritizing. Here are the top 3 priorities I need to work on. This little email that I can jump on that later, and blocking yourself off, and just really, understanding your own shortcomings, understanding yourself, and then addressing it, and then building systems around you that helps us solve those issues. So, if you know, for example, that again, that you're too quick to jump on emails, well, maybe when you start a project, just close your emails off, or mute your phone, or whatever that is, whatever tasks you have. Or for me, my background was in oil, so we came from the service side. So I will go out into the field and I'll jump in a pickup truck with one of our foremen or one of our operators, and I'm with you for the day. Show me how this works. What do you do? What are your hardships? Or when it's talking about geology, we're talking about engineering, whatever it is, I understand that that's not my background.
Right.
But I'd love to learn. I'd love to get more. So I don't enter the room as, sit down everyone, the smartest guy in the room's here. I enter the room as like, I'm a student and I'm here to learn from you. Your job's engineering, your job's operating, your job's geology. I need to learn as much as I can so that I can do a better job in the decisions we make. So, just having a little slice of humble pie, sure, you're the CEO, but you don't know how to operate better, you don't know how to engineer better. So shut up and learn from those guys. And if you trust that you've hired the best guys, then just being able to learn from them. I think it's hard for a lot of people to do that, especially once they get the title and I'm the boss and I have to have everything my way. If you can just put that aside and just say, listen, when it comes to what you do, you're the best in the company. I want to learn how to get better at it. Show me how this works. And a lot of people love that because it empowers them. They feel recognized. They understand that the talent they have is valued. So I think it kind of helps on both sides there.
Well, it's showing that vulnerability too, that you aren't the smartest guy in the room. You don't have all the answers, but you got a lot of smart people that work in the company. Yeah,
and our philosophy is like, listen, we're all relatively the same. I just have different responsibilities than some other people.
Right.
So when people come to me and said, why do we hedge, or why do we buy this company? Then I explain it to them. Now further. No, why did we drill that well? Why do we target that zone? So everyone has an expertise, and recognizing them, just appreciating you're a normal guy like everybody else. There are no egos. There's just different priorities and different skill sets, and to learn as much as you can from other people, and just acknowledge your shortcomings and work through them.
Excellent. Well, we're out of time, so thank you for spending some time with me, and obviously lots of nuggets shared, lots of great advice for any of our listeners. So again, thanks for being here.
Well, thanks so much for having me. This has been great.
And you've been listening to the Business in Calgary podcast powered by Sonic Coaching. I'm your host, Oliver Basner, and watch for our next episode in 2 weeks. Thanks, everyone.